All right, everybody, welcome back to another edition of Market Talks with Dr. Stoxx. This is Tuesday, Turnaround Tuesday, October 29th, and we are indeed seeing the market turn around from some weakness this morning to pretty good strength here in the afternoon. Now, we've got a whole slew of earnings coming up. AMD tonight, we've got Apple, Amazon, Microsoft, and several others whose ticker symbols I now forget. And we've also got data coming out. We've got CPI, we've got PPI, we've got non-farm payrolls, the unemployment rate, the jobless claims, the ISM for manufacturing, and on and on and on, a whole bunch of other minor ones. It's a huge week. And then we are just 1 week out from the general election 2024. And that, my friends, will determine whether the market is happy or not. It could lead to a black swan event. I was just talking about this over on StockTwits with some of the folks that follow me. It could be really not so good for the market if things really turn south and we see riots and breakouts and businesses getting destroyed and so on. We have seen that in and after elections in the past. Could be worse this time, in which case I don't think the market will be all that happy with it, but probably not going to happen. Probably going to get a good outcome for the market, and we should see some contingent plays do really well following the dust settling. All right, so we're going to do several things with you today. First off, I'm going to jump over to AAII.com. This is the American Alliance of International Investors, or independent-investors.com, something like that. It's a good site to go to, and you want to go to this link here, AAII Investor Sentiment Survey. Just jump over here once a month or so and kind of see what the trend is. The 2nd of October, the first week in October, 45.5% of all investors, independent investors, were bullish. Only 27% were bearish. That got even more extreme the next week, the 9th of October. 49% bullish, 20% bearish. Now, as it turns out, these extreme readings, bullish readings and very few bears, that is bearish. It seems like it would be bullish. And what generally happens is that when the market's going up, you get more and more bulls and fewer bears. And then you get to an extreme level. Everybody's bullish. Everybody's on board. There's nobody left to buy. And we get a market pullback. We've seen now not so much a pullback. We had a couple of days that looked a little scary, but mostly market, where's my hand? Market going sideways, right? Consolidating up and down, up and down, up and down within a very tight range, up near 52-week highs, at least for the S&P. Last week, the week of October 16th, things started to cool off a little bit because of that consolidation. And then in the week of October 23rd, the market actually did start to pull back. We had a couple of red days, a couple of days where it opened up higher and closed lower. And here we have now the most bearish week, according to sentiment, all month of October. That's actually a bullish thing. I kind of like to see it a little bit more. Maybe into next week, the election week, we see 32% bulls and 35% bears, something like that. But we're getting close to some historical averages. We've been pretty much above. We've been above historical averages on the bullish side. That is where we can get into a little bit of trouble. We want to see those numbers come down a little bit below the historical averages. Okay, so that's that. Keep an eye on that going into November. Now, November is the most bullish month of the year per seasonality going back to 1950. It is the second most bullish month of the year if you look at 200 years of market data. It's a very bullish month, and it launches the most bullish 6 months of the year, November through April. Very, very bullish time. So we're good. We're good for all kinds of reasons. Now, bond market has not been good. It has been in a major bear market since 2019. We're going on 5+ years now of bearish bonds. Why? That's a key question. Why are bonds totally out of favor? And this is a concern, major concern. For one, when bonds are down, yields are up. Yields mean capital is more expensive. Loans are more expensive. We just had mortgage rates tick down on the Fed cutting rates, ticked down to 6%. Looked like it was going to start to peak into the 5% range, which would be a beautiful number for a lot of people that bought mortgages up near 8%. Right? They can refinance and save lots of money, take some cash out if they want to. But we didn't. We didn't get that. We didn't get 5%. We got to bounce right back up to 7%. That's not good for the housing market and all the subsequent bricks, what do you call it, picks and shovels kinds of industries that support the housing market. Not good for that. Not good for car loans and the car makers. Not good for capital expenditures because they need loans. Not good for growth companies. Not good for biotechs. Not good for small caps. We want to see bonds catch a good bid. I do think there's a very good chance that bonds starting election day and onward will do just that. But lots of uncertainties yet to come. This is a kind of an unusual map. This is sort of this service, by the way, is Bravos Research. They're a good follow on Twitter. I like a lot of what they say. They're very good at explaining complex economic situations for people like me that don't have an economics background. They have great videos and great graphics and good commentary. My only problem with them is that they tend to be, I'm not going to say a perma bear, but they do tend to be leaning bearish when I think they should be leaning bullish. You've got the historical market at your back, right? The tailwind of the market has this bullish bias ever since it started. And we're living here in the greatest economic center of the world, the United States, at a pretty good time in our economic history. You don't really need to be bearish right now. Yeah, short term, right? Low market pullbacks, that's fine. Some distribution, that's fine. Okay, so that's actually a forward-looking bond market. They are seeing or expecting sort of a bottom out in the market somewhere, maybe it already happened, and then a rally into some resistance and then another leg lower. That's their map for bonds. I'm not so sure that's going to happen, but anyway, that's just speculative. This is the current map, and you can see this is the long-term 40-year uptrend in bonds. As the economy grows, the bond market grows, right? Because the bonds are what finance our growth, our GDP. It's what finances corporate growth. It's what finances government spending. Bonds, spending going up, economy going up, economy growing, GDP growing, bonds also growing. But all of that changed. Big crack of that 40-year uptrend, and we've been in this downtrend ever since. So here we are, not too far from a previous level of resistance, but man, you're just sort of clutching at straws to find the technical support for this chart. I just don't think it's there. We're going to have to get a change in the macro environment. We really want to see the Fed continue to cut some rates, even 25 basis points every other meeting. Heck, I would take that. And we want to see loan rates come down. Okay. Now, why are bonds going up? Well, here's why bonds are a problem, by the way. Most of your 401ks carry a pretty heavy load of bonds. 40% is the average. If you're nearing retirement, that's more like 80, 90%. Can you imagine if last 3 years of your retirement savings, you saw this 80% of your portfolio in a bear market when the stock market is going up to all-time highs? How frustrating is that? That's a big problem. People are going to be retiring with a lot less money that they thought they had, and they don't have it. So that's a problem. There's a good relationship between bonds and gold. Bonds, gold, and the dollar. You usually don't see the dollar and gold going up together at the same time. You rarely see that. And you also don't usually see the dollar going up and bonds coming down at the same time. So there are some strange anomalies there. I don't understand them. Bravos thinks they understand them. I'm not sure they do either. Anyway, this is the key. Why are bonds going down? Well, pretty simple. From the last election until now, this government spending has just gone crazy. It was going crazy under Trump too. Let's be honest. During the whole COVID period, there was pumping money into the economy right and left, buying out businesses, sending checks to everybody. That took a lot of spending. But that was pennies in the fountain compared to the kind of spending, especially that we've seen in the last year. That's good for the stock market, right? All that money going into government organizations that then need to form contracts with private companies. That's good for the overall economy, good for the overall stock market, not good for bonds. Not good at all for bonds. Why? Because in order to pay for all that spending, they have to sell bonds. They start selling lots and lots and lots and lots of bonds. That diminishes the value of the bonds and raises the yield. So yeah, it's not good. So we've got more spending going on right now than we did during the 2008 financial crisis, when the government was pumping money into the economy to try to keep it afloat. Now, of course, our economy is much bigger now than it was then. So apples and oranges. We also see last 3 years previous, also very high. This was the Trump alleviation of COVID. All right. All right. Yeah, that's it. That's all I wanted to say. So this is my thing. This is my thinking. If we get a change of administration and a change of Congress, to the degree, especially under the leadership of Elon Musk, who was just out saying the other day that he's thinking about cutting about 33% out of government spending, right? He's going to head up this DOGE, the Department of Government Efficiency. He wants to cut $2 trillion out of the $6 trillion annual budget, balance the budget, even bring in a surplus. That is going to be painful. Let's be honest, it's going to be painful. A lot of folks are going to lose their jobs. It's going to raise the unemployment rate, and it's going to, there will be benefits that have to get cut as well. But if we can do that, if we can get back to less government spending, we should see a massive rally in bonds, and it would be a beautiful sight to see. Of course, all of that I just said is uncertain, not written in stone, all future projection. Who knows what's going to happen after Tuesday? Let's look at some charts, guys. So we've got the S&P 500 doing a very nice, this is that little pullback that I mentioned, and it's very small, just down to the top of the 21-period moving average after a very, very nice run. We had one a few weeks back as well, right there. Took a few days to kind of get settled down, and then boom, breakout, nice big leg higher, same kind of consolidation. This one was more of a market pullback, right? So we had a test of, had a little bit of a range here just at the top of the midline of the LRC, and then we had this boom, big nasty downturn. That was on what? This is the Japan crash, the yen trade coming off. I'm not sure what this one, yen 2.0 maybe, something like that. Anyway, the market got spooked for a few days. Maybe it was a geopolitical thing, right? We've had a lot of skirmishes going on. Right back up again, few days later, consolidation, boom, consolidation, next leg higher coming very soon, should be a boom to the upside. And we're positioned nicely for it. The QQQ is having trouble with 500. Nice round number. We've been above it before, so this is not all-time high. But usually at round numbers, you get a lot of folks who either start taking profits and selling, going short, but you also get a large number of folks who hold 500 calls. And market makers being what they are, they would prefer to see those call buyers suffer the embarrassment of having to get out of worthless calls. So they probably want to keep it under 500, but market dynamics what they are, that's not their call. They can do what they want. The market is likely to go higher. I do think that these earnings that are going to come out, we've got a whole bunch of them, right, including Apple and Amazon and Google and Microsoft. These are the 3, 4, 5 biggest companies in the world. Their earnings will make a huge difference in the NASDAQ 100, to a lesser degree the S&P 500. I think they will be in part the catalyst that pushes us up higher to new all-time highs, but they're not all going to be perfect. I'm a little worried about Google, which is tomorrow night, and I'm also a little bit worried about Apple, although Apple's been making some good rumblings lately with China numbers coming out. So maybe Apple's okay, but Google, not so sure about. Amazon, not so sure about. And something like a Microsoft or an AMD, they're really going to have to be very good, very, very good, with good forward guidance to get them up and over the recent hurdles they've had. They've been both underperforming. So that's it. I don't think it's going to be earnings that pushes us up to new all-time highs. I think it's going to be the non-farm payrolls. I think it comes in a little bit cold. That's going to be good for the market. Inflation numbers also need to be low, or at least coming in line. Last month they weren't. They were above. So we want to see them come in line, even cool off a little bit. Good chance that I think they will, but you never know. All right, so that's QQQ. The small caps are still under some pressure today, but they were really up yesterday. They had a beautiful day yesterday. Triggered a buy signal, as I said. We've got oversold stochastics. We are in an uptrend. The stacked MAs, everything here looks good except for some recent distribution of shares on the pullback, and that's a nasty pullback, right? Compare that to the little consolidation of SPY where it's very still bullish. IWM got below the 21, tagged the 50 period moving average, has bounced a little bit, but having some trouble. We are long TNA with a diagonal debit spread, and I'll explain that here in just a minute. That to me is a very good way of playing the small cap index. You can do one on IWM. In fact, it has not just weekly calls, but daily calls, puts rather, that expire every single day. You could get premium coming in every day if you want. Be my guest. Too much stress for me. So, because I don't think that small caps are going to have a really good rally anytime real soon. I know Tom Lee is out saying 300 for the IWM by the end of the year. Don't see it. I just don't see it. But if we get Trump, if we get bonds starting to rally, yields coming down, if we get mainly yields coming down and interest rates coming down, then you'll see a good, healthy move in the small caps. Here's the bonds. They've been flirting with getting back to green today. Not quite there yet, but they're right flat, and that's a very nice recovery move. Let me show you some volume shelves here. I'll put on my, not the divergence, no, although that's also pretty good. I'm going to put on the Supply Demand Pro. And you can see these green levels down here. If it's green, well, there was a volume shelf up here. It was gray. That has disappeared, I guess, because this morning we went down below it. And then the indicator thinks that that's a violation of the shelf, and then the shelf disappears. So we've got some very good support right around 90. I don't think we're going to get to 90. We're almost at 92 right now. 92 is, if you look at intraday charts, hourly charts, 15-minute charts, 92 is going to clear some of that downtrending resistance. Then we need to get up above 93. 93 is really the big number. Anything above 93 for TLT, which is your 20-year T-bill, is a bullish reversal. If we can get a V bottom right in here, and I think the way things are shaping up for the forward economy on the election, we may just get it. If we can get a V bottom right in here and crack 93 by the end of the week, man, I think you're going to want to plow into bonds. I could be totally wrong. Could be the worst trade I've ever recommended, but I just think the odds, the probabilities are moving in that direction. All right. Gold is up again today. Let's take a look at my greens list, and then I'll talk about AVGO. So we've got the HAC, which is your cybersecurity index. We've been looking at this one for several days now. It tagged the 21 period moving average. That was a scary red stick right there. Volume was light, but that was a nasty one. And I'm forgetting exactly what caused that. One of the companies came out with some bad news. I don't think that it's earnings because they're still coming. And then it printed an inside day bar. Remember, inside day bars at the end of downtrends are bullish, at the top of uptrends bearish. This could be that reversal that the market wanted. 3 days of modest upside and a big green stick today. We had a lot of volume on that day right there. It shot way up. It tagged the resistance trend line, came right back down again, but still an up day. Slight up day yesterday, very good up day today. I like this index. I like it going forward. I think there's a lot of growth in cybersecurity, and there's some very good names in there. Fortinet, CrowdStrike. We're in Palo Alto with a diagonal debit spread and several others. CRM, big breakout today. Look, we're all the way up. Oh my goodness, the market's good today. We're all the way up here at the highs of the day. This is gorgeous, absolutely gorgeous. So we are long calls unofficially in the live trading room, and we are long shares officially in the live trading room, and both are just going off the charts today. By the way, if you're interested in joining us in the live training room, go to drstoxx.com, drstoxx.com, and click on the live trading button and follow the prompts there. AMD. Don't want to get into AMD before earnings, but man, I like this chart. Is it the best chart out there? No. Is it potentially really, really bullish? Yes. AMD has been a laggard. It's been underperforming. It is bound to play some catch up. They've got some good new product lines, but earnings are out tonight, and anything can happen on earnings. You can have a top and bottom line beat. You can raise guidance, but if you have one word out of place in your conference call, it can be, see you later. See you later, alligator. It's going to be like the Yankees, right? The Yankees are down 3 games. 3 games to nothing in the World Series this year. They're just having a horrible, they can't swing their bats at anything. They're striking out on every single kind of pitch. And that's not AMD. Sorry, AMD is really ready to rally here. Just we have to wait till earnings go. This is a software play, but I really like this chart. I don't like the volume balance, but it is in a nice uptrend. Stacked MAs, oversold stochastics, close to the 50-period moving average, reversal bar today. That is your buy signal. Volume still very, very light. We'd have to look at relative volume to see if that's true, but this looks very good. Just earnings are coming up. Same for Shop. Shop has earnings in a couple of weeks, but this is a modest pullback, 21-period moving average, oversold stochastics. Everything's uptrending. Facebook we're long Facebook right now, but we will get out tomorrow at the close. We're long a leveraged version of it, FBL, and it's doing really well for us today. It was kind of going nowhere for us for a while. Now, boom. Earnings tomorrow night. We don't want to hold over earnings, although they'll probably be pretty good. This is, I think, the best of the bags right now, and looks like it's ready for all-time highs. Affirm, nice pullback, 50-period moving average, reversal bar yesterday and today. Very good volume, oversold stochastics, a good short play into earnings. We're long PANW. This is really coming back nicely. We've got short the puts at 365. We're at 367 and change. We're above that, 100% profit for us this week. We're probably going to close this one out and replace it officially with AVGO. We'll talk about that in just a minute. Net. I used to really like this stock. It was in the IBD top 50 quite a bit. Lots of growth potential. And then they just started getting too much competition and couldn't keep up. So it's been a bit of a laggard, but they switched out or swapped out one of their sector executives for a guy that everybody loves. He's really good, apparently. I know nothing about him. And the market loved it. So it rallied from like 79 to 95 in just 3 days on that single change. So what does that tell us? It tells us the executive group of this company was not very good. Now they're starting to shift things around, and they've got a new $5 billion growth project under the direction of this guy that looks really good. So keep an eye on this. Not showing me yet what I'd like to see to go long, and earnings are close, but it looks good. All right, let's talk a little bit about AVGO. We'll make this one the last stock we talk about, and then I'll get over to Discord, our live room, and ask if you have any requests. Okay, so this is great. Big update. Came out with some news about the expansion of contract. No, I'm sorry, that's Netflix. AVGO also came out with some news. I'm forgetting exactly what it is, but it was very good news. We got in, about an hour passed, not a whole lot of movement, and then the news came out and boom, right back up. Now, did I plan that? Absolutely not. Did I know that was coming out? No. But it's nice when that happens. It happened to us also with Netflix today. So here's how we do the diagonal debit spread. You can only do these on stocks that have weekly options. This one does. The weekly options have to be liquid because you need to get in and out of them pretty quickly on a Friday afternoon. This one does. The weekly options have to have sufficient premium. My rule of thumb is that it is at least 1% for the at-the-money strike. So 1%, that would be $1.80 for AVGO at the money. And you're going to get actually closer to about 2% on this. So something like $3.50 for the at-the-money strike on AVGO. Now, maybe it's a little bit pumped up because we've got all these big earnings coming out. Maybe the implied volatility is kind of ramping up there, but it's good. It's good. And when you go out, so here, I'm sorry, I'm getting ahead of myself. The diagonal debit spread is made up of two positions. Two positions. One is a buy to open long-term put. Sorry, I can't write very well with my mouse. A buy to open long-term put, a put with time. Now, earnings are out here in the first week of December. Earnings are out here at the 5th of December, so we don't want to go out to that week. We're going to be paying too much money for that. We go out to the week before, which is like the last Friday of November, and we buy a put as our protection. This is our insurance put. What strike do we do for that? Well, we don't do at the money. We do something out of the money, and in order to determine the best price for that, we have to find a level of support, a level that we don't think between now and the expiration of that long put the price will go below. We don't want that put to be making money for us. We want that put to expire worthless. As counterintuitive as that sounds, we want that put to expire. This is insurance. It's protection. It also reduces greatly your overnight margin maintenance, the maintenance you need to have in your account, the cash you need to have in your account to hold this position overnight. Whew, that's a mouthful. Okay, so 170 was what I determined to be a good level. Where's 170? Right there. That's 170. It was support. It was support-ish here. Resistance, resistance, support, support, resistance, support. 170 is a good number. Market likes to interact with it a lot. It should act as support going forward for the next few weeks. We buy our put there. So we are buying 170 here, and we are going out to the end of November. It's about 5 weeks, right? There's a little bit left of this week, 3.5 days, and then we've got 4 full weeks after that. Then what we do as our second position is that we sell to open a weekly put. This one is OTM, out of the money, and this one is ATM, at the money, the closest strike to current price. So how do you know what strike is at the money? You look at the delta. When you see a delta value of 50, or it's close to 50 as you can get, that is the at the money strike. We sell that usually. Now, if we happen to think that the market's going to be a little bit wobbly the next week, we'll come down a little bit. We'll give ourselves a little bit of downside room just in case it falls back. That's just good money management. If we happen to think it's going to have a great week coming up, we can actually go a little bit in the money and take some more profit. But generally speaking, at the money. And in AVGO's case, we're going to be making back the cost of the long puts in 2 weeks, this week and next week. Then we have 3 weeks to purely benefit from that premium. You're going to make about $300 per week selling something near at the money, $340, $350, something like that. And if you do that for 3 weeks in a row, that's almost $1,000. If you multiply that times 2, which is what we're doing, that's $2,000. $2,000, one position held for 5 weeks. That's the goal. Now, that's pure profit. The first week and a half, it's a little less, it is less than that because we're going to spend $600 per long put. That would be $1,200 on that. And we're going to get back the same $350 for those weeks. That's $700. So $700 minus $1,200, our cost basis is $500, and we are making $2,000. All right. So over 5 weeks of time. Now, how much money do you need in your account? This is a $178 stock. You normally, if you want to buy 100 shares of that, in our case, 200 shares of this, you're going to need $37,000 of cash. You don't need that much money to manage 100 shares of this through selling puts. That's the beauty of this. So when I put this on earlier today, of course, the price was a bit lower. I paid about, just rounding it off, $600 for the long put. It was just a little bit over that. And I sold short at the money put for $330. So take $600 minus $330. That is, no, I'm sorry, that's not how it works. So I sold the 175 put. I went long the 170 put. 175 minus 170 is 5. That's $500 of margin requirement between those two strikes, because that's your maximum loss, minus the $333 that I got from selling the put. So I only need $170 in my account to hold one position overnight. Now, that's going to vary a little bit, right? As the price goes up, and if you're not moving or adjusting your long put, you're going to get more of a spread between the short and the long puts. That's your risk. So if it goes up to 175 to 185, now you're taking on $1,500 of risk per position, and you're going to have more cash in your account. But just imagine you're managing this massive $180 stock, and you only need $2,000 at the most in your account, maybe something like that, and you're profiting $2,000 over a 5-week period. That's 100% return, and it's actually a little bit better than that. Okay, anyway, it's just a great way of making income. Is it a get rich quick? No. Are you going to have a week where it just skyrockets and you're going to make all kinds of money? No, because as soon as it gets above the strike price of the put, you can't make any more money than that. Okay. So that's AVGO, perfect chart, great stock for this. It's not real volatile. Here's a good tip, by the way. If you go over to FinViz, this is the page for our live trading room, by the way. If you aren't trading with us, you need to. We've got a great group of traders, all levels. I do lots of teaching. We answer lots of questions. It's a great place to learn how to trade, but also a great place to get good trading ideas throughout the day. Not just for me, but from other members. But for me, I tell you what I'm buying, when I'm buying it, at the price I bought it at, my stop loss, where I plan to take profits, how I'm managing the trade, why I got into the trade, and all of the above. All right. I was going to go to FinViz. Let's go to finviz.com, your best one-stop shop for all things trading. And if you type in AVGO, one of the things you want to note with this diagonal debit spread strategy is you don't want to put it on something that's too volatile. Well, how do you know if a stock is volatile? Well, for one, you can just kind of eyeball the chart. What's the top of the range? What's the bottom of the range? And if it's just a massive up and down all the time, there have been some downs, right, with the rest of the market. So the volatility in the market is reflected in the volatility here. But how much more volatile is this than the S&P 500, for example? Simple way to do that. You go over to the beta, 1.18. This is only 18% more volatile than 500 of the largest blue chip stocks in the world. That's not very volatile. Let's compare this, for example, to NVIDIA. NVIDIA, where is its beta? 1.66. So this is 66% more volatile than the S&P. Our stock with a DDS on it is only 18% more volatile. That makes for a great candidate as long as you can get some decent premium, and we're getting 2%. Where's my number? 2%. Very good. Anything over 1% is good. All right, guys, that's all I have. I'm going to stop the recording here and wave goodbye to everybody who's following us on the YouTube channel, and then I'll get back over to the to Discord and look at your requests, and we'll look at some charts together. Give me a moment here, just a moment.